order to maintain internal price stability, RBI has to control the credit system. If you want to control the money circulation, they increase the interest rate. So it affects on the liquidity of commercial banks. In order to purchase or in order to rediscount the bills, they fix a standard rate, that is bank rate. RBI established a NABARD in the year July 1982 in order to oversee and in order to develop the overall rural as well as the agricultural credit. Hello everyone, a warm welcome to one and all to the second session on Law and Practice of Banking. I am Meghana from the Department of Commerce, lecturing in Vidhyaashram First Grade College, the Temple of Excellence. In today's session, let us discuss with the Reserve Bank of India. In the last class, we have discussed about the preamble, constitution and main functions of the RBI. In today's session, let us discuss with the measures of credit control, then RBI and agricultural credit and RBI and industrial credit. So, how RBI is going to help with the agricultural credit and industrial credit. Then how RBI is going to control with the credit. What all are the measures taken to control the credit. So all this we are going to study under this session. So let us start with the measures of credit control. First question, why you want to control the credit? So the importance of credit control. In order to maintain the economic stability, in order to maintain internal price stability, RBI has to control the credit system. That means the lending or the liquidity of the commercial banks. RBI is going to regulate and control the liquidity of the commercial bank based on the inflation and deflation. So based on this, they are going to regulate. So based on the inflation and deflation, they increase the interest rate, repo rate and reverse repo rate so that they control the credit. Using the various techniques, they are going to control the credit in economic system. So in order to maintain economic stability, they need to control the credit. So credit control is a function performed by the central bank, that is Reserve Bank of India, to control the credit, that is demand and supply of money or liquidity in the economy. So in order to control the liquidity position in the country. So based on the demand and supply of money, based on demand and supply, they are going to control the liquidity position in the country. So with this function, central bank regulates the credit granted by commercial bank to its customer. So the credit granted by the commercial bank to its customer, they regulate with this commercial banks. So the liquidity position of the commercial bank. So through the commercial banks, we are going to lend the money and we accept the deposits. So in order to control the credit, in order to control money circulation in the country, we need to control, we need to regulate with the commercial bank. RBI is going to regulate or control the money circulation in India using this commercial banks. So based on the demand and supply, they are going to control the credit. It aims to achieve the economic development with the stability as well as to manage the inflationary and deflationary pressure. So in order to maintain the inflation and deflation, so we are going to control this credit using this commercial banks along with the economic development as well as the stability. So we need to maintain the economic stability as well as it helps to contribute for the economic development. So keeping in mind all these points, we are going to control the credit in the Indian economy. So objectives of credit control. First is to attain the stability in the internal price level, to maintain the price stability in internal. So in order to maintain the price based on the money circulation, RBI regulates the money control. To obtain stability in the foreign exchange rate, which maintains the external value of the currency. Foreign exchange rate will influence on the Indian currency as well as it influenced by external source. In order to maintain the external value of currency, this RBI is going to regulate the credit control. So to maintain the stability in money market through liquidity control measure, through liquidity control in the sense money circulation. So demand and supply of money. RBI wants to increase the money circulation means they allow or they decrease the interest rate. If you want to control the money circulation, they increase the interest rate. So it affects on the liquidity of commercial banks. To promote overall economic growth and development by maximizing income, employment and output. To promote overall economic growth. So the main objective of RBI is to economic growth and price stability as well as the development. So in order to develop Indian economy by maximizing income, so maximizing individual income, then employment opportunity and final output. So for this purpose, they control the credit. Last one, to promote national interest. To promote national interest, they are going to control credit in Indian economy. Moving further, what all are the measures taken to control the credit? So, using two methods, RBI is going to regulate or control the credit system. First one is quantitative or general method and second one is qualitative or selective method. Through this two types, they are going to control the credit. So, this quantitative method, it includes bank rate, open market operation, variable cash reserve ratio, and this quantitative or selective method. The selective method includes credit rationing, direct action, moral preservation, publicity, regulation of consumers' credit, regulation of the marginal requirements on the security loans. So let us take one by one. So under that, first one is a bank rate. Under bank rate policy, RBI is going to fix the standard rate for rediscounting or purchasing the bills from the commercial banks like government approved bills and commercial papers. So for that, in order to purchase or in order to rediscount the bills, they fix a standard rate, that is bank rate. So based on the inflation and deflation, they make changes in the bank rate so that it influence on the credit control. It influence on the commercial banks borrowing. Through this, they can control the credit system in Indian economy. Next one is a open market option. So under open market option, RBI is in order to buy and sell capital market as well as the money market. So purchase and selling of security in the capital market and money market will influence, it fluctuates the money circulation in Indian economy. So through open market option, that means in the capital market as well as the money market. So purchase and selling of security by RBI is going to make difference or it influence on the money circulation in India. So that is open market option. So next one, variable cash reserve ratio. So variable cash reserve ratio, under that CRR and SLR, cash reserve ratio and statutory liquidity ratio. Through this rate, CRR ratio and SLR ratio, through this RBI is going to regulate the commercial banks based on the inflation and deflation. So in case of inflation, they increase the CRR. That means all the commercial bank has to maintain the cash reserve. From total deposits, they need to maintain some percentage as a cash reserve with the RBI. So in case of inflation, they increase the cash reserve ratio. So that commercial bank has to maintain a maximum percentage of money with the RBI. In case of deflation, they decrease the CRR and SLR ratio so that they relax the restriction or condition so that commercial banks have more money in order to circulate, in order to lend for their customer. So through this variable cash reserve ratio, CRR and SLR, they control the credit system in Indian economy. So these all are the quantitative or general method. Then selective methods. When we come to selective method, first one is a credit rationing. Under this method, RBI restrict money lending for particular sector or for the specific sector. RBI is restrict or its limit to the borrowing rates or borrowing money. That means the maximum money or maximum amount the commercial bank can lend for the specific sector, they are going to limit for that particular sector. So all the commercial bank has to maintain or they has to limit their lending for the particular sector. So through this credit rationing, they control the credit, money circulation. So next one is direct action. Under direct action, RBI, either they can use quantitative or qualitative method, that is general method or selective method. Using any method, they control the credit system. If the commercial bank fails to follow the instruction given by the RBI has the sole power in order to restrict the commercial bank, and they won't accept the purchase or repurchase of commercial paper and instruments for the commercial bank, so that money borrowing for the commercial banks from RBI is restricted. So they can take direct action in order to control the credit system. So if the commercial bank fails to follow the instruction given by the RBI have a sole power to control or to restrict, to take direct action on the commercial banks. So that is direct action. Next one, moral persuasion. So under this method, RBI is going to guide, RBI is going to give instruction for the commercial banks in order to control the credit system. The commercial bank has to follow all the instruction and guidelines given by the RBI in order to ensure, in order to control this credit system. Mainly the success of this moral persuasion depends on the cooperation between two banks, that is RBI and commercial banks. Commercial bank has to obey the instruction and guidelines given by the RBI. So then we can successfully control the credit system using moral persuasion. So next one is a regulation of consumer credit. Regulations of consumer credit. Under regulation of consumer credit, RBI is going to restrict the lending for the public. That means maximum money, maximum loan approved for the individual. RBI is going to restrict that money. So he is going to fix a limit for the lending. Through this, they can control, regulate the commercial banks. As an individual, you can approve only 5 lakh rupees for the individual. So based on the requirement, based on a different sector, so they restrict the money lending for the individuals. So that is regulation of commercial credit. Through quantitative and qualitative method, they control the credit system in Indian economy. So main objective is to maintain the money stability as well as maintain economic stability in order to contribute for the economic growth and development. So for this reason, RBI is going to control the credit in the Indian economy. So mainly based on the inflation and deflation, they restrict the lending from commercial banks. So this is all about the methods of credit control system. Moving further, next topic is RBI and agricultural credit. So RBI and agricultural credit, it includes agricultural development is regarded as prerequisite of economic development of the country, because we depend on the agriculture. Agriculture is a backbone for Indian economy. So it is a prerequisite for the economic development, because 70% of population in country are engaged in agricultural sector. So 70% of the population is engaged in the agricultural activity. So that we need to give importance for the agricultural activity. It helps to develop Indian economy. Development of Indian economy, it depends on agricultural development. So we need to contribute, or RBI needs to contribute and give importance for the agricultural credit and agricultural activity for the Indian economic development. The total share of the agriculture and allied sector in terms of percentage of GDP is 13.9% during 2013 and 2014. So GDP percentage for the agricultural purpose is 13.9% during 2013 and 14. So agricultural export constitute a fifth of the total export of the country. So agricultural activity, so total exports, fifth of the total exports of the country. The RBI realized the basis contribution of the agricultural sector in overall economic development. So for the overall economic development, agricultural sector will contribute. So because 70% of the population is engaged in the agricultural activity, so it contributes more for the economic development. So we need to give importance for the agricultural sector. We need to provide raw material for the industrial sector. Agricultural activity, they provide raw material for the industrial sector. So using raw material, they manufacture goods and they export or they sell it in the market. So for that purpose, so in order to manufacture the goods or services, we want raw material. So agricultural sector provides raw material for the industrial sector. So all the industry depends on the agricultural activity. Next one, provide the market for producer goods and consumer goods produced in the non-agricultural sector. So, provide a market for producer goods and consumer goods in non-agricultural sectors. So, we need to provide a market for consumer as well as the producer goods in non-agricultural sector. Provide a labor and capital to non-agricultural sector. Provide labor and capital. So, labor and capital is an important source in order to produce something, in order to produce your goods or services. So, we need to provide labor and capital to non-agricultural sector and provide a foreign exchange. So, in order to import and export, we need to provide foreign exchange. Next, credit. Agricultural credit is the key factor to accelerate agricultural development in India. The credit needs the farmer are of three kinds. So that means agricultural sectors. So the farmer needs three kinds of credit, that is short term, long term and medium term. So firstly, short term credit. Short term credit to finance agricultural operations like purchase of seeds, pesticides and fertilizers. In order to purchase seeds, pesticides and fertilizer, it requires short-term needs or short-term loans, short-term credit. So next one is secondly medium-term credit. In order to purchase the agricultural equipment, tractor and other implements to cultivate their lands with the help of modern implements. So in order to purchase the agricultural equipment, it requires medium-term credit or medium-term loan. So, RBI has to ensure all these points in order to contribute for the agricultural sector. So, first one is short-term credit, second one is a medium-term credit, third one is long-term credit for the agricultural development such as improvement of land, construction of boundaries and horticulture. So, in order to improve their land and improve the agricultural sector, it requires long-term credit. So, RBI has to ensure this short-term, medium and long-term credit for the agricultural sector. It helps the farmer to develop and to increase their agricultural activity, so that the final result, finally, it contributes for the economic development and growth. So, next, RBI, being the central bank of country, does not provide finance directly to the farmers. So directly RBI cannot provide finance for the farmers through the banks. It provides indirect facilities of agriculture through state cooperative banks. Through state cooperative banks, they provide loan or credit for the farmers. Though media of cooperative credit system, the RBI thus provides the three types of loan to the agricultural sector: short-term credit, medium-term credit and long-term credit. So, using state cooperative banks, they provide loans or facilities for the farmers. So, through the NABARD was established in July 1982 to oversee and development the entire rural credit system, including the agricultural credit. So, RBI established a NABARD in the year July 1982 in order to oversee and in order to develop the overall rural as well as the agricultural credit. So, not only for the agricultural purpose, it is for the rural credit system as well as the agricultural credit. For the agricultural purpose as well as for the rural development, RBI established this NABARD. The major of the agricultural credit department of RBI and the entire undertaking of the ARDC was taken over by it. So, overall agricultural or rural development is taken over by NABARD. It took over from the RBI the refinance, development and statutory inspection of cooperative banks and RRB. Now, RBI has the power for the lending of money or financing for the rural and agricultural department. So, it developed the statutory inspection of cooperative banks and RRB, regional rural banks. So, now RBI mainly is established in order to provide facilities for the rural area. So, NABARD provides rural credit by way of refinance and loans and advances to the state cooperative banks. So, NABARD is going to refinance for the state cooperative banks. Through the state cooperative bank, farmers and rural sector will get finance or short-term, medium and long-term loans from the state cooperative banks. So, land and development banks, not only through the state cooperative banks through the land and development, RRB and other approved financial institution for financing production, marketing and investment activity related to agriculture. So through this, state cooperative banks, land and development banks, RRB and approved financial institution for the manufacturing, that is producing and marketing and investment activities. Through this institution, they lend money for the agricultural purpose to agriculture and other allied economic activities in the rural area. Not only for the agricultural activity, other activity in the rural area. They finance for the other activities and rural areas. Now, we have discussed about the NABARD. The full form of NABARD. NABARD means National Bank for Agricultural and Rural Development. So, National Bank for Agricultural and Rural Development was established in July 1982 by RBI. So, this is all about NABARD and RBI and agricultural credit. So, moving further, the last topic under Unit 2 is RBI and industrial credit. Rapid industrialization is a key accelerator for the economic growth and development. So, along with the agricultural activity, this industrial activity will also a key accelerator for the economic growth. Prerequisites of industrial development are 5 M's, that is man, material, machine, management and money. So, these all are the 5 key factors for the industrial development or for the industrial success. So, money is the primary essential in industry. That means from this 5 M's, money is the main factors which contributes for the industrial development. So, without money, no man can work. Then you cannot purchase a material and land, anything. So, for all the activity, the main or key factor is money. So, RBI has to ensure that money or finance for the industrial development. It necessitates an adequate supply of short-term and long-term finance for the purchase of industries, fixed and working capital. For the industrial requirements, to meet the fixed and working capital expenses, RBI has to ensure the short-term and long-term finance. So, short-term and long-term finance for the industrial purpose. So, small-scale industry is confined to urban and semi-urban as well as the rural area. All the small-scale industries are limited to urban, semi-urban and rural area. This small and large industries have their typical borrowing, short-term needs as well as the long-term needs. So, this short and large industries have their typical borrowing needs. So, they require short-term as well as the long-term credit in order to meet their fixed and working capital expenses and for their industrial purpose. So, commercial banks have been providing short-term credit to the industrial sector, but they did not favor long-term industrial finance in pre-independence era. So, this commercial banks, so for the agricultural activity through state cooperative banks and RRB helps to provide short, medium and long-term finance for the agricultural activity. For this industrial needs, this commercial bank is going to provide the finance, but they provide only a short-term finance for the industrial purpose in pre-independence era. So, the capital market also underdeveloped in the country. So, capital market is also underdeveloped in the country during this pre-independence era. After independence and during the planning era, therefore, the Reserve Bank of India assumed the major responsibility of easing the problem of industrial finance. So, during this planning era, RBI importance is to solve the problem of this industrial finance. So, for that, they need to come up with the new ideas. They come up with the solution for this industrial finance problem. Through the term lending institution, the following term lending institution have been started with the Reserve Bank's initiatives and support. This term lending institution started with the initiatives of RBI. So, the Industrial Finance Corporation of India, the IFCI, in the year 1948 in order to provide short-term, medium-term, long-term finance for the industry. Next, the State Financial Corporation SFC in the year 1951 and 52 in order to provide finance for the industrial purpose. So the Industrial Development Bank of India, IDBI, 1962. So these all are the term lending institution, short-term and long-term credit lending institution for the industrial purpose. So for the agricultural purpose, we have a separate banks or institution, and for the industrial purpose, we have separate institution, that is IFCI, SFC and IDBI. These all are the institution for the industrial purpose. RBI is going to contribute for the agricultural sector as well as for the industrial sector for the overall economic development. So these all are the contribution from the RBI for the agriculture and industrial sector. So they concentrate on overall economic development and price stability. So this is all about RBI. This is all about Unit 2, that is Reserve Bank of India. So let us meet in the next session with the Unit 3. Until then, keep watching. Thank you.